All right, I want to welcome everybody to the Lumberyard. Once again, very excited to have our guest speaker today, Cody Daniels, founder of Builders Tax Group, specializing in tax strategies for construction and service trades businesses. Not only is he the founder of that, he also authored Laying the Foundation, a contractor's guide to strategic tax savings where you can minimize taxes for contractors. And also, it is available free for download. And this is actually our second uh, part of the series that we're doing with Cody. When we did part one, that one we focused on financial statements, the foundation of tax strategy. Then we went into talking about entity structure and then picking the right accounting method. And so we're going to dive back into it. But let me go ahead, let me welcome Cody, and then he'll give you an introduction to what we're going to cover today. So, welcome, Cody, to the show.
Yeah, Jennifer, thanks so much for having me back. Always a good day to talk taxes.
Yeah, absolutely. So, what are we going to talk about today, Cody?
Yeah, so today, I think in the last session, like you alluded to, we talked about pretty foundational tax strategies every contractor should be implementing. Today, we're going to talk about maybe some more overlooked strategies or maybe misunderstood strategies, things that maybe as a business owner you've heard a little bit about, but maybe you don't have a great understanding of. But if available to you, are certainly strategies that could result in significant tax savings.
Awesome. Well, let's go ahead and let's dive right into it. So, the first strategy, what would you say that would be?
Yeah, so the first of these three strategies is considering tax credits and incentives. I think a lot of business owners, when they think about tax credits, think about, like large publicly traded Fortune 500 type businesses. Maybe they think about specialized industries such as tech or, maybe like oil and gas, like energy type credits, things like that. But even within construction and the trades, there's a lot of opportunity to take advantage of various credits if you know where to look.
All right. So, give me some examples that contractors might qualify for.
Yeah, so the first one that comes to mind is the research and development tax credit. This is a federal tax credit designed to reward businesses that invest in innovation, process improvement, problem solving. So you'll notice I didn't say anything about like technological advancement or anything like that. So there's plenty of opportunity for construction businesses to take advantage of this credit. There's obvious opportunities such as maybe electrical contractors getting into solar energy or something like that, but even less obvious opportunities if you're developing like innovative building techniques, improving construction processes, or using new and innovative raw materials.
All right. And then if they use this credit, how would you then, as a tax advisor, how would you know or how would you tell them that this is available?
Yeah, so I think having an in-depth conversation with your tax advisor, talking about the type of activities that you're doing. Certainly, if you're somebody that has like engineers on staff and you're doing more like engineering-based activities, that might be a sign that hey, there's some opportunities here. I will say it's something that most CPAs we don't produce the studies in-house, these
Okay.
R&D tax credit studies. So this is something where we're likely to refer you to an outside firm that can prepare a comprehensive credit study. And the process for that is it's not too burdensome necessarily on the business
Mhm.
owner. The process is they're going to focus on interviewing your different employees. Your employees are going to have to track time on qualifying activities, but
Okay.
these firms they'll walk you through the process, give you sort of a guidebook to follow, and then they'll produce on an annual basis this comprehensive R&D tax credit study report.
Okay. Perfect. No, good to know. So then we have the R&D. What would be another tax credit?
Yeah, so another one is the work opportunity tax credit, and I will caveat this by saying right now this is set to expire at the end of 2025.
Okay.
However, throughout the life of this tax credit, there have been various expirations in prior years, and the federal government has extended it at various times. In my understanding, it was not part of the One Big Beautiful Bill Act that passed recently.
Okay.
Uh, but my understanding is there is bipartisan support to extending this credit. So, as always with taxes, stay tuned, stay aware because things are likely to change at any moment. Uh, but the purpose of the credit is to reward businesses that hire individuals from certain targeted groups, such as veterans, ex felons, long term unemployed individuals, or individuals that receive certain public benefits, such as SNAP or SSI.
Okay. And what is the typical like credit range that you see for eligible employees that are hired?
Yeah, it's going to vary. Some of it's going to depend on how long the employee works for you, but the credits can range from anywhere around $2,400 per employee upwards of $9,600 per
Okay.
eligible employee. So could certainly be significant if you're hiring um, many individuals from these protected groups.
Okay. So then how would an employer claim this credit?
Yeah, so again, this is another area where your CPA is probably not going to be able to work you through the process entirely in-house. Typically, to claim the credit, the employers need to complete a screening and certification process to verify that these individuals meet the criteria to be eligible for the credit. And
Okay.
typically, they're going to want to work with an outside firm. And my understanding, Jennifer, is that Lumber has recently acquired BuilderFax
We
and
did.
could
Yep.
could help out employers with this certification process.
Yeah, yeah, absolutely. We really make credential management simple using BuilderFacts. So all of your workforces like certifications, licenses, and training are kept all in one place. So that is something that we added, we acquired back in May.
Awesome. Yeah, and it's really not something that somebody's going to be able to do internally. They're going to need that outside resource with that specialization to make
Mhm.
it cost effective to do this. This is like a whole separate process that you shouldn't be burdening your internal employees with learning that. You should really be relying on your experts to work through that process for you.
Okay. No, good to know. So we have R&D credit, the work opportunity tax credit. What's another one that you have for us?
Another one that I see that's commonly overlooked are various fuel tax credits. So there are federal credits available to recover the excise taxes paid on fuel if the fuel is used for off-highway purposes, such as being used in construction equipment or vehicles that are not driven on public roads.
Okay, and so let's talk more about this. What would be some good examples for contractors?
Yeah, so I think if you're a road builder, if you're a excavation or like demolition contractor, I've seen this in practice with a lot of landscapers. So you can see how those types of businesses would be using significant amounts
Yeah,
of fuel in off-highway purposes. And the credits are significant. For gasoline, it's currently 18.3 cents. Per gallon,
yeah.
and 24.3 cents per gallon for diesel. So you can see again, if you're a road builder, like a demolition contractor, that this could add up to significant dollars at the end of the year. There is a process that you'll need to implement. Again, this is one you probably could do internally, where you're going to have
Hmm.
to maintain a record to differentiate between on-road usage and off-road consumption. So
Hmm.
um, again, like a lot of my landscapers, they have a fueling tank on site to fuel up their mowers and their other small equipment and things like that. So you may implement a policy that the on-site fueling is just for equipment, and all of your vehicles that are taking the crews to different job sites, maybe they're getting their fuel at local fuel stations and things like that. So that could be a very easy way to separate the two and help you track this in an efficient manner.
Yeah, that's a really good idea for contractors to do. Okay. So then we have that one. Still going along the lines of vehicles, what is another one that can contractors can? have?
Yeah, there are still, for a very short amount of time, electrical vehicle credits available to anyone interested in buying like electric vehicles, whether for like fleet purposes or just kind of owner business used vehicles, things like that. I will say these credits are sunsetting very quickly. The One Big Beautiful Bill Act did move forward the sunset date for these credits. It's now September 30th, 2025.
Okay.
So if you're somebody that's interested in acquiring an electric vehicle, you're going to need to move pretty quickly and make those purchases before September 30th. Otherwise, those credits will cease to be available.
Okay. Do you know what the credit is for electric vehicles?
Offhand, I think it's $7,500.
Okay.
I probably should have double checked
I
that,
know
but
personally that's what it is.
yeah,
If I were to go buy one, it's 7,500.
yeah. So I think there's a reduced credit for used vehicles that's still available. Most of these credits now they're not claimed on your income tax return. Most of them can be claimed at the dealership when you make the purchase now. So it's the burden of reporting has shifted away from us as the CPAs over to the dealerships that are responsible in most
Mm.
cases for facilitating that credit.
Okay. Good to know. And any other specific credits that you want to mention?
Nothing specific, but I do want to mention that there are some state level credits and incentives out there, typically, again, around hiring. So there are some like state level credits similar to work opportunity tax credit. There may be credits at the state level for training. And then there may be, state like energy type credits as well, where some states do have, credits for alternative fuel vehicles and things like that. So, obviously, not something that I know the inner workings of every single state, but that's why you work with the CPA. We can certainly research
Mhm.
these things and do deep dive for clients to assess what might be available based on the states that they're operating in.
Okay. And it's very important to talk to your tax pro about these credits before filing, not
Right.
after.
Right. Yeah. There's a lot of this that has to be handled real time and
Mhm.
after the fact. As with most things in tax, it's hard to go back in time and set these things up properly. So yeah, the work opportunity tax credit, for example, that's really something you
Mhm.
want to be on top of because you need to be submitting the certifications during the onboarding process. It takes time
Mhm.
for these certifications to process. So in order to complete your tax return on time, you really want to be doing this as you're hiring employees and not trying to, go back in time, submit the certifications after they've been working for you for a period of time, and just kind of dragging out the process. Otherwise, you're gonna really kind of put yourself in a bad position when it comes time to file your tax return.
Yeah, absolutely. All right, that was a good strategy again, considering tax credits and incentives. So let's move on to strategy number two, taking advantage of accelerated depreciation. So do you want to go ahead and expand on strategy two for us?
Yeah, absolutely. I think this one is maybe not so much an overlooked strategy as a misunderstood strategy. I think most construction business owners know that hey, we're in an industry where depending on what you're doing, you may have pretty significant capex expenditures, and you want to make sure you're getting the advantage of depreciation on that capex. The issue is that I think there's frequently misunderstanding around the different methods for taking advantage of depreciation. So, first, I kind of want to dive into Section 179. I think most
Okay.
business owners are aware of Section 179. It allows for immediate expensing of eligible assets per the One Big Beautiful Bill Act. It's now increased up to $2.5 million per year. So, significant increase in
Very.
the threshold that allows us to take advantage of writing off those assets. It is unique in that it's elected on an asset by asset basis, and that's going to differ from something like bonus depreciation, which we'll dive into next.
Okay.
One downside of Section 179 is that it cannot create a loss.
Mm.
So you can only bring your taxable income down to zero. But what I like about Section 179 is that it gives you a lot of flexibility because you can elect it on an asset by asset basis. So there may be very specific reasons why you do not want to drive your taxable income all the way down to zero, or
Mhm.
use something like bonus depreciation to create a loss. I mean, you may have expiring tax credit carryovers, you may have expiring loss carryovers from prior years. And if you drive your income down to zero or to a loss, you're going to lose out on those prior year benefits that you generated for yourself. So there may be very strategic reasons why you target a specific amount of income, and Section 179 gives you a ton of flexibility to, uh, if you're placing in service significant fixed assets during the year, like really kind of target like almost to the
Mhm.
dollar, like what you want your taxable income to be for the year.
Okay. And that's why you need to talk to your tax pro to be able to uh, go into a deeper dive with that and determine
Right.
what is your best situation.
Right. Yeah. Sometimes good tax planning is not just about driving to the lowest number possible. Sometimes it's
Mhm.
about, looking at the picture holistically, looking at other sources of income that you may have, looking at tax rates. Just there's a lot more that goes into it than like, let's just drive all the way to zero.
Sure, sure. Okay. So you talked about section 179 and then you hinted on bonus depreciation. Let's talk about that one.
Yeah, so bonus depreciation, a lot of similarities to Section 179. Again, the One Big Beautiful Bill Act has reinstated 100% bonus depreciation, so it's very similar to 179 in that we can use it to fully write off the cost of eligible assets. And that bill made 100% bonus depreciation permanent. So
Mm,
unlike the Tax Cuts and Jobs Act, which provided 100% bonus depreciation for a period of years and then scheduled it to slowly sunset over a number of years, we do have 100% bonus depreciation. I will say permanently. What that means in the tax law is until another bill is passed that changes it. But the current bill, there is no scheduled sunsetting or termination of 100% bonus depreciation.
okay. Okay.
So so we have a lot of opportunity there. One of the differences between bonus and 179 is that for bonus, it is by default an election in. So if you
Hmm.
do not want to claim bonus, you have to include a statement electing out of bonus depreciation. And it's elected on an entire class of assets. So all 5-year assets, for example, which for contractors would include, most of their equipment and vehicles would be 5-year assets. So you don't have quite the same flexibility as Section 179 in that you can't pick and choose individual assets. It's individual classes of assets.
Okay. Okay, good. And then what is another accelerated depreciation that we can look at?
Yeah, so I think this is very overlooked, and I've actually heard in conversation with other CPAs that there are some people in our industry that don't even believe that this is legal to do,
Mm,
and that is a cost segregation study. So a cost segregation study is a tax-focused study that can be conducted on real estate to identify components of real estate that can be depreciated over shorter years. So, generally speaking, real estate is depreciated over a very long, time period. For residential properties, it's 27 and a half years. For commercial properties, it's 39 years. So you can see if you're investing in real estate, it takes you a very long time to recover those costs.
mm-hmm.
Well, with the cost segregation study, we can come in and identify components of the building that qualify for shorter tax lives. So some examples of that might be many types of flooring qualify for 5-year tax life. Most things like furnitures and fixtures qualify for 7-year tax life. And actually, if you look to the exterior of the
Mm-hmm.
building, most of the areas around the building, such as like landscaping, parking lots, sidewalks, anything that's kind of like a land improvement, qualifies for a 15-year tax life. And what makes this incredibly beneficial is that now, with this 100% bonus depreciation available, anything that we reclassify to like a 5, 7, or 15-year tax life now qualifies for that 100% bonus depreciation. So we can fully write off those dollars entirely in the year that you've placed the building in service. So depending on the type of building, I think you could easily write off if it's acquired, placed in service after January 19, 2025. So that's when the new bonus rules come into effect. But if you acquire it after that date and we have 100% bonus depreciation available to us, I think you could easily write off between 15 and 40% of the entire purchase price of that building in year one.
I feel like when this goes live, a lot of our tax pros, our tax experts are going to be getting phone calls from contractors out there when they're listening to this going, you can do
Yeah,
what?
I,
You
I,
can
I
do
would
what?
hope so because this ties in so well to construction because the vast majority of contractors I know get into real estate as a form of investment in some capacity. It may just be the building that they're operating out of. They'll frequently own that. And that's enough. If you own just that building, that's great.
Mhm.
But if you're a contractor that is getting into other forms of real estate investing, whether it's commercial, residential, whatever types of properties that you're acquiring and renting out, there's some significant opportunity there to generate significant tax write-offs and potentially, depending on your circumstances, offset the profits from your construction business with those write-offs.
Awesome. So, what would be some strategic angles you would say for contractors out there?
Yeah, I think this has to be an integral part of your year-end tax planning. With most of my contractors, we have the conversation every fall. Should I go out and buy some new trucks? Should I go out and buy some new vans? And I will say that I wouldn't put the cart before the horse when it comes to tax planning. Again, like I said earlier, good tax planning is not all about necessarily driving down to zero. If you don't need that equipment, like if you're not going to use, the new truck, the new van, whatever it might be, I wouldn't advocate for somebody to spend 50 grand to generate 20 grand of tax savings. That doesn't make good economic sense.
Mm-mm.
But if you're a growing business, if you're a business that has aging equipment, can definitely benefit from adding more to the fleet, adding more or replacing old, whatever it might be. Um, I think you have to consider this as a significant tax saving strategy as you kind of approach year end.
Couldn't agree with you more. Couldn't agree with you more. Awesome. Well, let's go ahead and let's dive into strategy three, implementing a tax efficient retirement plan. Care to expand more on this one?
Yeah. Again, I think this is frequently overlooked. It's something that's easy to put on the back burner, especially like in your startup years where you may be a little more cash strapped. It's hard to justify. I'm going to put away X dollars, for 20, 30 years down the road. If I can take those dollars and again continue to grow the business, make that next hire, get that next crew on the road, whatever it might be. But I do think that retirement planning is obviously it's a key part of tax strategy, but also it's just a key part of building your wealth overall as a business owner.
Yeah, absolutely. So, what are some options for small construction businesses?
Yeah, so for purposes of this discussion, I've kind of lumped a few different plans together. You can look at like a 401k, something like a SEP IRA, maybe even a profit sharing plan. Um, this is another area, kind of like some of the credits, where you really need to bring in your team of outside experts to work together on this. Your CPA is very likely not like a financial planner, investment advisor type person. Certainly some are.
Hmm.
Certainly they have those services in house, but a lot of us don't have those services in house. So we need to bring in other members of the team of experts to help advise on this because I'm probably not the person to break down the nuances and some of the subtleties around the plans. I can tell you from a tax planning perspective, what makes sense and what we might consider doing. But I think it's a good thing to work with the financial planner, investment advisor on setting up the plan and getting their feedback from all that as well. But as far as those kind of initial sort of 401k SEPs, things like that like more new businesses are likely to implement. From a tax planning perspective, it's important to recognize that we have tax deductible contributions that we can
Hmm.
make into those accounts. Frequently, we have tax deferred growth with those accounts, And in certain cases, again, if you're like a startup, you may want to consider a Roth option. So like a 401k
Mm.
might provide a Roth option for you. Again, that's where you got to really work together, hand in hand with the CPA and the investment advisor to work through those things. But the thing that I like about the retirement plan, just overall as a tax planning strategy,
Yeah.
and maybe we can contrast this with like the purchase of the vehicle. Let's say we're coming to year end, you got an extra 50 grand that you want to put somewhere. You can go out and buy a truck with that, and you can generate 50 grand of tax write off. That 50 grand's going into a dealer's hands, right?
Hmm.
If you take 50 grand and you put it into a retirement plan, that stays with you. Those are still your dollars, right?
Hmm.
So
Hmm.
um, it's really one of those areas where you can generate a current year tax deduction for yourself while keeping the dollars in your pocket, right? It's just right pocket, left pocket. We're taking it
Yeah,
out of
exactly.
our current account. We're putting it into a different account that's still for us. Yeah, maybe we can't touch it for several years without incurring a penalty, but we're still retaining that full 50 grand as opposed to taking that money out and handing it over to another business. Again, there's no right or wrong answer here. Like
Hmm.
depending on where you're at with your business, the truck purchase may make sense. The retirement, contribution may make sense. But that's why you got to be working with somebody and talking through those different strategies.
Yep, yep. Different scenarios and what's going to work best for you. Absolutely. What about cash balance plans?
Yeah, this is an area that I think can work really well for construction businesses if you have the right dynamics. So,
Hmm.
in contrast to like the 401ks, the SEPs, plans like that are considered defined contribution plans. A cash balance plan is more akin to like a traditional retirement, like a traditional pension plan, like a defined benefit plan. So it is a different way of thinking about things, but if the dynamics are right, I think it can really help business owners save significant dollars for themselves. I think you have to be a little bit more of a mature business, so you got to have meaningful profits and cash flow to contribute to it because it is different in that there is an actuarial calculation that will determine how much you can contribute to the plan. It's not something like a 401k where you got like a sort of hard cap that you can put into it. There's a more complicated calculation around what you're required to contribute. Not that you can contribute, but you may be required to
Hmm.
make contributions of a certain amount. It works really well for businesses where you have a small population of employees that participate in the plan.
Okay.
So
Hmm.
I've seen this work really well for union contractors that have non-union member owners. So if you're the owner of the business and you drop your union card, you can create this cash balance plan. And the bulk of the monies that go into this are going to typically be for you as the business owner. You may have some other non-union employees, like maybe some office staff and things like that, that have to participate in, and certainly some of the dollars are going to go to them. But I've worked with clients in the past where upwards 80-90% of the total contribution is going to the owners in these plans. And
Mm.
because they have high contribution limits, it really works out well if you're maybe one of those businesses that did put retirement planning on the back burner early in your career, because you have a lot of opportunity to make up those contributions later in your career due to the high contribution limits available to you.
Okay. Okay. Good point there. What about employee stock ownership plans?
Yeah, ESOPs.
Yep.
Admittedly, not an area that I have seen in practice a lot. I've been in public accounting for 13 years. I've only seen this in practice twice, but it's an area that the more I learn about it, the more I'm intrigued by it, and I definitely see it as again a good option for the construction industry. Similar to a cash balance plan, I think you probably need to be a little bit more mature in your business for this to make sense. You need to have probably a larger employee base. From what I've heard, typically you need to have at least 25 employees to make this make sense. But
Hmm.
it can be a really interesting strategy for transitioning ownership away from the original owner group to the employees, getting the employees invested in the business, rowing in the same direction, because they're going to directly reap benefits from the success of the business. So it's a great transition plan. But there are significant tax benefits as well. The contributions to the plan are tax deductible, just like all the other plans we've talked about.
Yep.
Um, if you're the original owner or owners of the business, there may be opportunities as you start to sell off your stock in the business to defer or even potentially eliminate some of the capital gain associated with that stock. So that can be a very powerful tax saving strategy as well. And again, like your employees and yourself as the owner can benefit from the tax deferred growth associated with using the plan. The one downside I will say is that unlike any of the other retirement plans, there's no diversification here. It's all tied to the business.
Hmm.
So so it's definitely putting a lot of your eggs in a single basket. But again, if you're a growing, profitable construction company, I think it's a very valid strategy.
Yeah, absolutely. Now, what would you say would be an advantage or a bonus for employers to offer retirement plans?
Yeah, I mean, I think in this day and age, it's kind of table stakes for hiring good employees. Even as a small business, I think people are expecting that. So if you want to attract like the best talent and retain the best talent, it's kind of bare minimum to offer like some sort of retirement plan and to be contributing to that plan on behalf of your employees. So any one of these plans I think is a good option. But yeah, I think you got to have something to bring in the top tier talent.
Yeah, absolutely. Anything else that you want to cover with these three strategies that we just spoke about today?
No, I think it's we're in a very interesting time with the tax bill passing pretty recently, the One Big Beautiful Bill Act. So there are certainly elements of that bill that impact some of these things, like the changes to bonus depreciation, Section 179.
Hmm.
There are other things in that bill that might start to play into some of these things. Like there's these Trump accounts that you can set up for kids as kind of a savings plan for children. That maybe how can you package that into sort of your just overall like estate planning, wealth planning, relative to your other like retirement contribution plans, education plans, things like that. So there's a lot of things happening right now
Hmm.
that have impacts on these strategies. But overall, I mean, these are pretty evergreen strategies. There's nothing within the tax law that is saying no, that you should absolutely not take advantage of depreciation. You should not be considering R&D credit studies if they're available to you. There's just a lot going on right now that says tax planning should be at the forefront of all business owners' minds because of
Hmm.
all these changes. There's so many opportunities. And like we've said multiple times throughout this episode, last episode, like you don't want to wait until next year to say, hey, I should have been doing this. Like you need to get in front of it. You need to be having these conversations now, so that you can take advantage of every option available to you and ultimately hopefully create significant wealth for yourself in the process.
Yeah, absolutely. Couldn't agree with you more. And again, I just really encourage those listening today, um, go ahead, give Cody a call. We're going to put a link to download his ebook in the notes as well. And then we're also going to do another recording where we're going to wrap up this ebook of the chapters of it. So we're going to go ahead and do a part three. But it won't stop from there. We're going to keep these recordings going because there's a lot to it, a lot of advantages that you can take from them. So, Cody, it's been an absolute pleasure. I look forward to part three. But if you missed it, we also recorded a part one. This is part two, and then part three coming up. So, again, Cody, thank you so much. And I wish everybody a great day.
Thanks, Jennifer.